Today, I'm coming to you again from Florida, because as you guys know, I'm here since December 28th, so we'll be here till probably April, start of April. And anyway, we're actually we're trying to stay tonight in one of the properties we just turned around. If you've been following my stories, I get this sweet leather reclining chair with USB charger. The lumbar, it goes back, there's lumbar support, the legs kick out. I got this chair for free, for $0. I was able to get that, maybe partly because of the YouTube channel, maybe partly because of my Instagram following and the guy was, a supporter. But we bought a couch for an amazing deal. It was like 1/3 retail. And he threw in this chair for free and he delivered it and set it up and everything. I couldn't believe it. We're finding such amazing deals setting up this Airbnb down here, and we're roughing it. The kitchen's torn apart and everything, and there's guys coming to urethane spray it, and I'm working every day, trying to get this property turned around. But we're going to attempt to sleep in here. So looks like we have a flickering light bulb. I'll have to address that too. Saw too many deals today, so I thought I would just title it like deals, deal. Florida. A lot of wholesalers I've been talking to down here, a lot of realtors, a lot of exclusive stuff. I talked to, some realtors who are saying people are getting 30% under ask accepted offers. There's just so much opportunity out here right now. As an example, you can buy like a nice concrete block, 2-car garage, 3-bed, 2-bath, like minimum is kind of like what I would look for. You can find those rentals for like under 200 grand in Florida. And you can rent them out for, well over $2,000 a month. So you're talking about well over 12% annual, return of tenants. Well, the more important thing is that these properties, you can buy them for 200, they're worth 300 on the open market. And so you can make 100 grand on closing. If you put 100 grand down, that's a doubling your money. Where can you double your money with the chance of losing money? When you're buying a $300,000 property for 200,000, the chance of losing money is pretty much zero. Like real estate market collapses 20-30%. You're fine. You're in a cash flow positive property. You're now at break even. You hold it for 5 years, you win. So the biggest thing you can do, I think right now, is just buy at a discount. Get out there and hunt. I'm seeing, I don't even have enough capital, and even the people that I know, if I were to raise the parameter to say you're buying with 20% down, so you put 80% mortgage, 20% down. Right now, I can double that 20% down payment in like 3 to 4 months. And I can do that. I could do a deal a week at that volume here in Florida, like no problem. Back in Ontario, it can be done. I'm still finding deals once a month pop in that meet those criteria, but it's a lot more savage down here. Like there's so many more opportunities on both coasts even. Like I've got wholesalers sending me stuff from Tampa all the way down to Naples. And then on the East Coast, the same is true from Jacksonville, Daytona, down to Port St. Lucie, which is where I am right now, West Palm Beach, where I am right now, and then down to Fort Lauderdale and right down to Miami and even south of Miami, like the whole way. And then Central Florida, you'll find stuff. Someone sent me a 20-unit building that was like $50,000 a unit. The market rent is $1,200 a unit. So you're talking, if you're buying at $50,000 a unit, you can rent it out for $1,000 a month. You literally pay off the unit in, just the rent. There's gonna be some expenses and stuff, but you pay that off in 50 months. In 50 months, the building pays itself off in rent collected. Like what? Now, if you have a mortgage on that and you're putting 20% down, that means you're cashed out in like 2 years. That's if you don't add value to the building, which you will because you're buying at a good discount. You turn the property around, you renovate it, et cetera, and so forth. Just, to me, there's just so much opportunity. At the same time, let's talk crypto, let's talk, stocks, let's talk what's been going on in the world right now. There's a ton of opportunity in the world. I think crypto, there is opportunity there. I think we're going to see a further bottoming before we see, that next rip up into the next halvening a year and a half from now. It is a bit speculative in nature, so I wouldn't put all your eggs in that basket. In the stock market right now, it's so volatile. I'm pretty much neutral. I have some positions still that I'm holding, but I'm not 100% sold on the idea that, we're at the bottom. Some people think we're at the bottom. I don't know. For me, real estate just provides an opportunity that, and by the way, if you guys are joining the stream tonight and you're putting comments below, feel free to answer all the questions like I do every Wednesday for the last 5 years. I've never missed a stream. Came on when I had COVID, came on the day after one of my daughters was born, came on Christmas, New Year's one time. Every 7 days, I'm live every Wednesday, 7 to 8 p.m. So you guys know that. If you're just finding my channel, welcome to the channel. Here to help. Anything related to money, finance, investing, That's what I love. That's my jam. So happy to share what I'm coming across right now. So what other areas have you been looking at in Florida? So again, I said I'm looking at both sides of the coast. I like to focus East Coast. Again, I think that there's more potential for, well, so Miami can't really grow south. Not really. It has to really grow north. And so I think north of Miami, we're talking, this is really far north of Miami, but like West Palm Beach, Port St. Lucie is one of the top 10 fastest growing cities. I really like that one a lot too. Just the price wise too, I found it was just phenomenal. The water isn't as warm as on the Gulf side. However, I think there's a specific advantage to that when we talk about hurricane damage and we talk about how weather is going to impact things. Specifically, I like that it's so close to the Bahamas too. So for me, it's also strategic in nature in that like I want to create a triangle between the Bahamas and Florida, and this is part of that triangle. I love what's going on the west coast of Florida too. We toured every city. Last winter, I just like lived like a vagrant. We went through every single city in Florida. We'll call it south of Jacksonville, south of Tampa. So I didn't touch, like all the way up in like Pensacola and like the whole northern part of Florida. Wasn't interested in that. I like southern Florida because if you're in like Jacksonville, it's cold at night. You might need like a coat. It's so cold. It gets below freezing sometimes in the northern parts of Florida, even in central Florida, but it stays nice and warm on the coast, especially down in Miami. Miami is the warmest city on average daily, nightly temperatures year round. It's the warmest city. It's most southern tip. So that brings some advantages, right? And I think that attracts all of the US snowbird community, and it attracts vacationers. It attracts people wanting to move to the state for political reasons. I'm very bullish on Florida. I also like Arizona. There's other states that I like. There's a few other states, but yeah. Canada's great too. I mean, a lot of you guys follow me. I invest in Canada too. But Canada's got some political challenges. Gurinder says, hi, Mike, thanks for hosting. Any predictions for Q1 earnings for big tech? Well, I would say I think they're going to shit the bed. So that's just my prediction. And not every company. I think Meta's going to blow. Well, Meta could have a bad earnings. It's possible they could blow expectations but do really well in the next 4 or 5 years. But I think Meta's going to continue to produce strong cash flow. I like the way Zuck has been. This may not show up in this earnings season, but I like the way he's been pivoting. I like that Amazon's laying off a ton of people. They're a little late to the game on that, so I think they're going to get punished in Q1. But I see companies like Amazon, Alphabet, Meta, all the big tech, I see them now laying people off, getting smart about things. Honestly, even Tesla's current change and pricing strategy, I like the way they're moving. Short term, it's going to be painful for them, but I think long term, there's some potential there. Tesla's a tough pill for me to swallow because there's so many like perma bulls that are invested in Tesla and keep the valuation at a level that I just don't love. They have to do a lot of things right, and they've already done so much right. It's hard to continue to be the market leader, especially when Elon's focus is divided. I don't know. Under $80 a share, I think Tesla is a buy. At that point, I think the entire market is a buy. When we see the NASDAQ, the QQQ, as our kind of a reference point, geez, that light bulb's flickering. It's tripping me out. I'll have to change it. Again, we're under Reynolds. There's a lot of things going on here. I wouldn't have it any other way. The Rosehart way is to live through the chaos. I've done that most of my life, so not a big deal. I'm tough. I'm meant to go through this stuff. But go back to my thesis here. I think that we will see the VIX, the volatility index, spike to 40 plus at the bottom of the market just before the Fed U-turns. It'll be painful. Once they U-turn, that's the buying opportunity. So when the Fed changes their mind and says, hey, we're done. Well, there is also still a scenario, guys. Like I said 3 streams ago, I was talking about how there's a real possibility that we go through the 80s era, the Paul Volcker era, where, the Fed then played like a roller coaster game. Where it's like, oh, we're going to take it easy on you guys and stimulate, and then we're going to go hard, and then we're going to bail out the market. And then, so it could be a roller coaster. This goes on for a while. I think it's more likely than not, the bond market believes that the world seems to be pricing in that the Fed's tough talk is short-lived and that they will pivot and U-turn, and which means rates are going to come back down. When that happens, it'll be euphoria. Just beautiful. Dun, dun, dun. So I guess to sum up the last year question, I was just scrolling back to it there, Gurinder, related to predictions for Q1 earnings. I think it's going to be a mixed bag, but I think it's going to be bad. So inflation is on its way down month over month. And the recession is starting to take hold. People are suffering. They're living on credit still, so it's not that bad. People are racking up their credit cards. They're drawing down their personal lines of credits. They're using all the access credit, and the layoffs haven't really hit that hard yet. So the ramifications of the wealth effect that was destroyed last year in 2022 haven't really been felt yet. So I think it's possible that earnings are bad because inflation is dropping, and inflation saved earnings last year. So despite things were bad in 2022, inflation was running wild and increasing. And so because inflation was up 6%, earnings were blowing out of the water. It's like the analysts weren't factoring in, hey, we're going through like a hyperinflationary type period where prices were kind of getting out of control, especially in the first half of 2022, even with like used cars and new cars and advertising too. Businesses were still spending like crazy. And people were the Fed was literally signaling at the end of 2021, early 2022, it was like, go borrow as much, mostly in 2021, but the Fed was coming out and being like, borrow as much as you want. We promise rates will stay low. And it's like they just lied through their teeth. Bank of Canada specifically was like, this is the time to stimulate the economy. We want you to borrow, keeping rates low. Look, rates are going to stay low for the foreseeable future. That was, wrong, obviously, but they were encouraging people to take money out and to spend. And so people were spending on marketing and whatnot. So a lot of these companies are strong ad revenue focused. And so we're going to see those cutbacks, more of that into 2023 with the layoffs, but businesses in general are going to be tightening their belts. And so I think we will see a pullback. Will we see it in Q1? There's a good probability. It could be a good buying season. So am I sitting, if I had a portfolio, would I sit on some cash right now? Yeah, I think there's gonna be some, even just leading up to earnings, you could, not that you wanna gamble earnings, but there's a real possibility that you could play the volatility before earnings. There might be some bad news comes out before the earnings and we get a 10% dip in the stock prices of some of these companies. So it could be a buying opportunity. If you believe earnings are gonna be fine, or you're a long-term investor and you're looking 3 to 5 years out, you don't care that, prices, what they do in the next 6 months. You're gonna hold. So if, Meta falls another 10, 20%, you don't care because you bought now at a 45, 50%, 60%? Yeah, 60% discount from the all-time highs. And so you don't care, right? You're gonna hold it for 5 years. Doesn't matter what it does in the next 6 months because your target to sell is when Meta's at $300 a share again. And you don't care what happens in between now and then. You know that's gonna happen. Same within real estate, right? Don't panic sell right now. This is not the time to be panic selling. This is the time to start buying. If you're building a portfolio, now you start buying. We're getting into the buying season before the U-turn, before rates come back down. There's no one competing against you because nothing cash flows. All the rates are, like the US 30-year mortgage right now is like almost 6.5, 6.8 if you're a good borrower, maybe 6.25. You're around 7% almost. And cap rates in every major city are like 4 or 3. Some major cities like LA and New York are like 2. So imagine where the cap rate and the cost of borrowing are out of whack. The cap rate should be at the same or higher. The cap rate is the return, net income return divided by the asset price that gives you basically your valuation for any investment property. You need to look at the cap rate. And so if the net return of the asset, if you bought it in cash, is worse than the cost of borrowing, if you apply leverage, which real estate is built on leverage, it is the best asset because you can lever it without margin call. Whereas in the stock market, you get margin called. In real estate, you don't get margin called. So it's one of the best asset classes because you can lever up against it and never get margin called as long as you make your payments. So it's just a beautiful asset for that reason. That's why people love it. That's why they pool their capital into it. It's a safe, stable, cash flow positive, debt self-servicing asset that is also inefficient as hell. I mean, you can go and find mom and pops selling their sixplex for half of market value just because they like you. No one sells their Apple shares for half. It's not liquid. And so real estate, you can arbitrage the hell out of it. You can, what they call wedge deal or arbitrage deal. And that's what I love about real estate, where you can't do that in the stock market. That said, there is some opportunity in the stock market right now. So many things you can chase. I would just split the bag right down the middle, half in real estate, half in the stock market. And I like to buy individual properties as opposed to large, funds, because I think the large funds can't buy enough of the quality. There's not enough quality inventory for the large funds to chase. And so for that reason, I would rather build my own portfolio. Even if I have to partner with someone, because let's say you want to do it passively, you didn't want to have to deal with, tenant calls and toilet leaks and, like I always have cuts, and you can see where I cut myself 2 weeks ago. It's almost healed now, the day this renovation started. In almost 2 weeks, we turned this whole house around, by the way, in Florida. We ripped out floors, we're ripping out bathrooms, redoing the kitchen. Entire house, almost 2,700 square feet, I think it is. All the floors, all the walls, mudded, taped, all the trim changed out, painted, everything. This would have taken some people months. We got this done in a week. In under a week, the majority of the renovation's done. Now we're gonna do slowly the bathrooms and some staging and stuff. So it's gonna probably take like another few weeks to do all that stuff. But and the pool's coming along. It's getting there. We chose instead of draining the pool, we chose to take the Florida pool. The motor was broken, so I had to put a new motor on. It was all seized, new filter, cartridge. There's a whole bunch of issues with the pool. The waterfalls are all working out. All 3 waterfalls are working. It sounds glorious in the backyard. But the pool's still cloudy. We've been pouring in chemicals. We're working with a local pool guy to try to do it in a way that's the least risky. You drain a pool. You're supposed to drain a pool, acid wash it, and then start fresh. We used the existing green water and we fixed it. We added stuff. We pumped it. We shot back some of the water out and got all the sludge out, and been working with that water to get it back for like half the price. Again, just all cost saving stuff. I went to a yard sale today, garage selling, like Gary Vee would say, and we picked up a Dyson vacuum for the house for $39. Regularly like $350. So I'm just loving all the deals down here. The same things I do in Canada, I'm able to do here, just better. There's just more enterprise opportunity here. People are more capitalist in nature. It's just, I don't know, just so much opportunity. I love it. I love being down here. The weather's warm. We're 28 degrees. In Canada, it's freezing. It's shitty. I get bright sun in the morning. It's just, we haven't had rain in a week almost. Like there's like rain like once a week. Just beautiful sun, clear skies every day. It's just fantastic. I love spending time down here. There's nothing better. I have all the amenities of home. It's like it's a first world haven. It's great. Of course, it's not a tax haven, unfortunately. Florida has no state tax, but there's still federal tax anywhere you live in the United States except for Puerto Rico. But who wants to live in Puerto Rico? 6 months a year. Unfortunately, that's the requirement. More than 6 months a year in Puerto Rico to get those tax requirements. But next question was from Mike. Whereabouts are all these deals? Near the coast or inner part? All over. All over, Mike. There is a deal in every city right now. You can go on the MLS and you could throw offers out, and within a month of throwing out offers at 20-30% discount, something will click. And so that's where there's everywhere. Wholesalers, off-market, exclusive, knock doors, Craigslist, marketplace, everywhere. There's just so many opportunities. It might get worse. So that's the thing that's kind of holding us back a little bit from going all out, is like things might get worse. You have to buy stuff that cash flows. You have to buy stuff that you can Airbnb play, and it could work as a rental. It has to work for both, right? Because if you have to pivot, not that you I don't think you have to pivot, but if Airbnb gets bad, you sometimes have to drop your prices to a little bit above market furnished rentals. So like a furnished rental rents for like 25% more than an unfurnished rental, right? So that's basically the worst case scenario. So you run that on a mansion, like a $2, $3, $4, $5 million place, and it makes no sense. So people are buying luxury stuff. It doesn't always make sense. If you're a really good operator, it can make sense. You can find a good operator. You can find good staff. You can find good systems. The systems are always changing too, so you gotta stay on top of it. The algorithm's always changing. You gotta stay on top of the Airbnb and the VRBO and all those systems and sites. You have to stay on top of those algorithms. And so I would say it's better to buy a property that out the gate can cash flow. So for me, I'm looking at properties in the 100,000 to 399,000 range. I like that for like my single family with a guest house or an in-law suite, my duplex, that sort of sweet spot. I like that a lot because it just, to me, there's just so much value in, like I could buy a $250,000 house in Florida and it's concrete block, better construction than back in Canada, designed to withstand the hurricanes here. And just from a cost to build per square foot and for the value of the underlying land, you're buying these houses for like 50, 100 grand under what it would cost to replace them in many cases, sometimes more. And so I buy those all day. I'd love a portfolio of those because if you go to, let's say you go to like Pompano Beach or like Fort Lauderdale or even West Palm Beach, your multifamily is still $200 and a quarter a unit. If you're close to the beach, you're almost 300,000 per unit. Would I rather have a small, like a 1-bedroom apartment is going for $325,000 a unit in a 20-unit building, when I can just buy a 2,000 square foot, 4-bedroom, 2 full bath with a 2-car garage and a pool on its own land in Florida as well? I'd much rather have a portfolio of 50 properties, like homes, than units that are small, 300 square foot. So I don't see the value as much in the large multifamily space. Now, there are some properties that are piquing my interest, but by and large, I've been digging into the bigger deals and I'm like, in all the nicer areas, the cap rates don't make any sense right now. I'd much rather buy, 30 minutes outside of in a smaller 500,000 population city in Florida than right in, Miami or something, or Fort Lauderdale, and pay the premium. Like, the $1.5 million house doesn't cash flow. The $1 million house in Naples doesn't cash flow. It doesn't make sense. Like, not really. When you can buy a $300,000 house and get 3/4 of the rent you would have got on a $1 million house through Airbnb or just as a rental. You know what I mean? It's just so much better to have. Like, I would just love 100 $250,000 properties in Florida. That would be my goal over the next 5 years, to get 100 of them and just buy them all at $250,000 a piece. Quality, in the last 10, 20 years construction, with concrete block that can withstand, with good grading, that can handle the test of time. I think those properties, buy them up now and into this dip. I'm gonna buy 100 of them, I think, probably with some partners, because it's gonna be hard to buy all that myself. And I think in 5 years, they'll be worth $500,000 a piece, easily, for these nice. In Canada, this same house would be like $800,000 Canadian. So it's just, to me, it just blows my mind how they're able to do that down here. And the cash flow actually makes sense. You got cash flow positive, nice single family portfolio. That is much more attractive to me than a large multifamily. That said, I think my thesis, I guess, is that multifamily is going to correct. And I think we're going to see, because rates are going to keep staying higher longer than they thought, for a while, people are going to hold their multifamily, but eventually, we're already seeing huge defaults. In California, the people, big $250 million, $500 million defaults from these large multifamily operators, because it doesn't make sense. Their properties are cash flowing at a 2 cap with rent control, and they're borrowed at variable rates that, or if they have to refinance, 4, 5, 6%. And so they can't carry unless they own it in cash. In which case, why would you want to own something in cash that cap rates 2 or 3? You've got bonds that pay 5 or 6, right? Like, what are you doing to get 2 or 3%? It's just not a great place to park capital, in my opinion. Now, there's the appreciation factor. I get it. I have friends who are in this space, like Mike, but like, I bought my building in Toronto, or I bought my building in New York or LA for like $2 million. It's worth $4 million now. And like, in 10 years, it's gonna be worth $8 million. So I don't care about the cash flow. And like, okay, I can see that argument, but like, there'll be just more appreciation, I think, on the undervalue home that you can buy right now from a distressed buyer for $250,000, $250,000, that's gonna be worth $500,000. And so I get that double, and I get all that cash flow. And if I'm wrong, and it takes 7 years instead of 3 years to double, because it will double over time, that's just a fact. It's demographic trends, cost of building increasing, cost of labor increasing, inflation's gonna carry everything. There's a number of reasons why real estate just continues to go up over time, specifically in desirable areas like Florida, that are the fastest growing states in the US. But regardless of that, you've got cash flow. And if you're wrong, you've got a building you bought that's worth $350, that you bought for $250, and you got cash flow positive every month. So you can hold that thing forever, and you're making money. You're happy. You're making a 15, 20% return just on holding it. Forget the fact that when you bought it, you also made 100% return on your down payment. Like, and then there's appreciation on top of that. Where can you do that? There's nowhere where I can invest, get 10, 15% return, and then also double my money. Like, bonds, you get your money back. That's it. You made an 8% return. Woohoo, for a year. Or if you did it for 5 years, you might make 20, 30%. That's it. You make all that interest for that 5-year period. You're not gonna get that double that you can get in real estate. So I don't know, I'm still, as much as I hate the fact that real estate isn't passive, and just by my nature, I have a hard time allowing it to be passive. I need to get involved to keep costs under control. That's part of what makes me a great operator, but it also is shitty in the sense that I have to be here, spending time, investing. Like, even if I'm not there, like, we have 8 flips going in Canada right now while I'm here, and I'm still texting my guys. Not that much, actually. Like, I don't want to brag here, but like, I'm actually not spending that much time. Like, maybe a couple hours a week, maybe 20 minutes a week per flip. It's running very smoothly. I have great people, and like, you know what? If they're watching right now, like if my brother's watching right now, or Jonas is watching right now, or even my dad's watching right now, or Jake, if you're watching this right now, like all of our great people, Clay, Logan, if you watch this replay, I'm super impressed with what you've been doing in your first one. I've got a triplex there in London that we're doing. We just closed on like 2 weeks ago, not even. Super proud of my team of people that are getting things done. By the way, I'm throwing this out there. It might be a position for my brother, but if someone wants to move to Florida and is handy, understands construction, and wants to GC a bunch of Airbnb turnarounds, flips, all that kind of stuff, the construction stuff, basically getting contractors in, We try to find really cheap sub trades. We don't use GCs. So your role will be to manage all the sub trades. So if there's, a taper, a painter, a flooring guy, you have another handyman that's doing the small odds and ends. When you hire these guys that are 20 bucks an hour, you're going to have to babysit them a little bit, kind of make sure they don't mess things up, walk behind them, deficiency battles, cost battles sometimes when they underquote and things. There's all that goes along with it. And so if someone watching this, I have a pretty good network, and a lot of people probably would reach out for this, but this position could pay 6 figures a year. It could be a profit sharing position. It could be a salaried position. You could easily make 6 figures in this role. If you live in Florida or want to be in Florida, let's chat, because I could use someone to be me in that role so that I can just go out there and hunt, and I can just buy, and I can go buy 10 of these places for 200 grand a piece. We can put 50,000 in each of them and spend 500,000 or $1 million in renovations. So that's a real business, turning these properties around. And then I can go and focus on what I'm best at, which is finding these properties 100 grand under market value. I shouldn't be spending any time on site, like maybe once in the beginning to give a direction and then check in when it's done. I'd like to be able to get a team going here. So if you're one of those people, you know someone who might be a good fit for that position, let me know. I need a right-hand man. I need someone who just understands construction back and front, who's done flips, construction type projects in the flipping market. They have to have that expertise, and they have to have done it. And so if they want to partner up, I'm all ears to discuss that further. Okay, back to the Q&A here. Let me get caught up. I'm way behind now. There's a lot of questions here. Okay, Rocky. Hi, Mike. I have a cash flowing student rental and we'll owe $3,300 in rental income after tax, after deducting expenses, insurance, mortgage expenses. Do you have any secrets on lowering your rental income tax? Rocky, first things first. If you're gonna hold this property for a long time, depreciate. Have you done any capital expenditures to the property? You can take all of those capital expenditures and you can write some of them off as maintenance, by the way. So if you replace a toilet and it was broken and it was like the same price as repairing it, that's a maintenance item, I would argue. You can deduct the entire cost of labor and material on that item in this tax year. So what I do at the end of the year, if I know a property is going to be profitable, I'm like, is there anywhere I can add value to this property to get my tax liability to zero? Or like, okay, I can't advise some of this stuff, but imagine you had a bucket of receipts and you could spill them between properties. You could spread things out. Don't do that. That's probably tax evasion. What you can do legally, though, is find renovation projects or maintenance that might be deferred and do that to reduce your tax burden. Also, you can start depreciating the building. So in future years, you'll have to recapture that depreciation if you sell the property. But if you don't plan to sell it for a long time, take a big depreciation hit and depreciate the building. If the building was worth $500,000, you're not able to depreciate 6% in a given year. I don't know what the class schedules look like. Talk to your accountant about that. This is not financial advice, but you could depreciate that building and probably get $20,000, $30,000, or $3,300 in write-off easily. There's also other expenses people don't think about. Like if you log when you drive to your property, your insurance, your gas, your car depreciation, all of that you can depreciate across your properties. I drive more than 50%. Like my vehicle is primarily driven for business. I almost never drive for personal. Both vehicles, I mostly drive for business. But so anyway, you can write off a good percentage of that too. People don't think about that until later. If you've used a personal home equity line of credit or a mortgage on your personal house and then taken that money to buy a property, all of your personal mortgage interest in Canada is tax deductible. I have $2 million mortgage on my house at home and it's all tax deductible. The entire thing. I used all that money to go and Smith maneuver and invest. And so I deduct all the interest on my house, which is like insane because it's a variable rate mortgage right now. I have 6 figures in interest. So I throw that against the assets that I use that capital to fund. So that's another thing is like maybe you have expenses at home office, hydro, bookkeeping expenses. There's a whole bunch of different expenses. Sit with your accountant, think through it. There are always ways to get your property down to zero. The first 2 years you operate a property, you should always operate at a loss. So I use real estate as a way to, when you're trying to find fire and you're working right now, you can use your property to easily, if you had to say 2-3 properties, they should all be running at losses your first years because you have vacancy when you're renovating them. You put a whole bunch of money into the deferred maintenance. If you're smart when you bought the way I buy, there's a ton of deferred maintenance. They've been kicking the can down the road on a lot of items for a long time. So you catch that property up on its maintenance schedule and you do all the maintenance items in the first year or two and get the property in just mint condition. All of those are deductible. So in the first 2 years, you're actually improving the value of the property. You pay no tax. If you buy a property for $350,000 and it's worth $500,000, you added $150,000 in value, you pay no tax on that. You can get access to that cash by refinancing that property. Put a mortgage on it, boom, take the cash out. You're paid. You got money in your pocket, cash in the bank, and you pay no tax on that until you sell that asset down the line. And if you don't plan to sell it for a long time or until you're dead, kick the can down the road for the next person, right? Your heirs can worry about the tax liability on that. And by the time it's gotten to that point, the tax liability is, the value of a dollar is decreasing over time. So 70 years from now, who cares? You know what I mean? It's like almost you paid nothing. It's 70 years of interest-free loan from the government on tax you would have had to pay if you sold that asset. So there's a really good train of thought. If you're working a job right now making 80 grand a year, 100 grand a year, you should be loading up your RRSP to get the tax deferrals in Canada, your registered retirement savings plans. You should be loading up your rental properties and buying stuff that's distressed. The more distressed, the better, because you get write-offs that can bring your, like I think when I was making 50 grand a year, my year one, I had 2 rentals. Year 2, I had 4, I think. Year 3, I had like 10 or 12. When I acquired all those properties, all of them were at operating losses because I had a lot of vacancy. There was some rent coming in from some of the units, but there was turnover, getting the tenants out. A lot of them didn't pay. And once they're out, then there's 3, 4, 5 months of you turning the property around, getting it rented out, refinancing and all that. There's not a lot of revenue coming in and a lot of expenses. And even if it is rented, you have the deferred maintenance, you might be improving the property. You can write a lot of that off. So I had rental properties that were each like cash flow negative $1,000 a month. A lot of these ones when I'm fixing them up, that's how it worked out. And I have depreciation too. So you throw in you can't use depreciation to create a bigger loss, I don't think. That's not legal. So if you had a gain on a property, you could use depreciation, but if you just have like a ton of maintenance and a ton of expenses that have built up, and then that year that you're turning it around, you got all the interest expenses and carrying costs, you can use all that to create a tax loss. And so I had these properties creating, each T776 of my rental properties in my personal name was creating losses. And so when you're starting your real estate journey, you want to own your personal name. You don't want to be in a corp. If you have a high income job, you want to be in your personal name. Because one, it's considered passive income, and so capital gains are half tax-free in your personal name, which is great. It's the same in a corp technically, but it's an easier argument to argue it's a long-term rental hold in your personal name, so it's just nice and easy. Insurance covers any liability issues you have, so get a great insurance policy. You should definitely do that. And then you have losses in your first 2 years. When you're operating a business, you first buy a business, there's losses in the first couple of years. That's natural. The CRA expects that. You will need to show profit or have sold the property. If it's not making money by year 3, there's a problem. You need to sell that asset off, or you're faking your numbers or something. I don't know, but like property should be cash flow positive. And so, the first 2 years it's expected. You use those losses while you're trying to save for your financial independence. You're socking it all the way into rental properties. You're paying no tax, 0. My first 3 years working, I paid almost no tax because I was sheltering it all in using my real estate portfolio to offset any tax. And so then down the road, you have a huge gain, right? Which I do. I owe a huge gain coming up here in April. I think I owe about $1 million in tax. I have $2 million capital gain between my wife and I. We sold off, I sold off, you guys know, in 2022. I sold off in January 2022. So before the top of the market, I didn't get the top. I sold in 2021. They all closed in 2022. So I had an extra year to invest that tax money. I've owed, technically the property sold January 2022. It's been over a year now. I won't owe until April. So I thought, hey, I'll get an extra year and 1.4 years to invest the money, which I put into crypto and to stocks. Unfortunately, lost a lot of the tax money that I owe. Whatever, it is what it is. Had it been a bull market or a flat market, I would have made a ton of money, but it was a bear market, so it is what it is. But the point being, now I'm going to pay tax, and it's okay because my first property was over a decade, 10 years ago, right? And so I've deferred tax for a long time, and I sold the portfolio partly because I thought it was overvalued. What I sold my properties for, I wouldn't buy them for, all of them. And I could go buy all the properties I sold back right now for 25% less, or suitable equivalent properties probably for 30% less. So no regrets in selling at all. I'm way net ahead for having sold most of my portfolio off. I now primarily just flip. And that's because I continue to find undervalued assets in London, in Ontario, here in Florida too, but primarily in Ontario. That's where my network is, and that's where I get a lot of deals that I've planted seeds years ago that continue to bear fruit today. So people still call me like, hey, Mike, I got a deal. And I did a deal with them last year. They know I can close. They call me up, we do a deal. So that still is going to continue to happen. I will continue to do deals because it's low-hanging fruit. Like I can't not take these properties down. And it's not interesting for me to hold a property in Ontario because the landlord-tenant board rights are so strong and Airbnb is being banned in most cities. London, it's banned. Your primary residence is the only way you can Airbnb now. So for the most part, to do a large Airbnb business is illegal in most cities, Toronto, Vancouver, London, most of the larger cities. So anyway, for that reason, I'm mostly doing flipping. And it's just because I look at the asset when it's done And when I buy a property for 300, when I'm done with it, I love the property. I make it the way I want it. I make it cash flow strong. If I have to hold it, I can. It's cash flow positive. But then I look at it and like, an investor's going to pay me for 550 grand for this house right now. Like, I'll just take 100 grand right now. It'd take me 10 years of cash flowing to make that same amount of money, right? So I just take the money now and move on to the next deal. And that's because I have so many deals in front of me that I always see the next undervalued asset in front of me. It makes it hard to want to resist buying the next shiny thing. And it's just, and I end up being a flipper because I continue to buy undervalued assets. Hey, Mike, as a Canadian, what are the steps I have to go through to buy in the US? Nothing. Canadians can buy real estate in Florida in their personal name anytime they want. RBC, Bank of Montreal, TD, all have locations in Florida, as an example, in the United States. There's a BMO Harris Bank in Florida. There's several of them. So you just go through my private banking connected me to private banking and BMO here. I can borrow 75% loan to value anytime. So it's no big deal. Legal and tax implications. So if you buy in your personal name, there's no double taxation. So buying your personal name is the safest place to start investing in the US. I think it's the best way to go. We have basically a symbiotic relationship where the US will tax you, but because your tax rate is higher in Canada, you pay no tax in the US. You get a credit for all the tax that you paid in the US. There are some corporate structures where you can set up in the US and in Canada and end up in a situation where you have some double taxation. So be careful with the corporate structures, talk to an accountant. But the way I've been told, the best way to start, if you're just buying 1 or 2 properties, buy them in your personal name. There's no double taxation. You're in a great situation. So definitely do that. CCA, you can claim CCA. It's a great way to do it. As far as secrets, I can't think of anything off the top of my head, but I'm sure if I was sitting there with you or you're sitting with your accountant, you could think of some stuff that would definitely help you improve your situation. The rental properties and real estate in general is very tax preferred. It's a tax preferred asset. It's just, you can kick the can down the road. You kick as much as you can into long term. So continue to invest in your properties, have them be really, really nice, and then you can kick that capital gain down the road to the future. So I would say, don't be a slumlord, run quality properties, invest in the properties heavily. That will allow you to defer tax because you're increasing the value of the asset by putting that money into it. You're paying no tax because you're getting your operating cash flow, say it's $1,000 a month, down to 0. And so, but that's okay because you're investing in the property. If you need cash flow to live, you can refinance the property every year or 2 and pull your money out because you're increasing the value in the property. So that's the best way, I think, to invest in real estate from a tax perspective. If you're thinking about the tax tail and you're letting that wag the dog, you shouldn't do that. That's what they say. They say don't let the tax tail wag the dog, which means don't make decisions based entirely on tax situations. And here I am wanting to move to the Bahamas. I just don't want to file anymore, to be honest. Like the fact that personally you don't have to file a tax return personally in the Bahamas, that's huge. That's huge. Just the filing is a pain in the ass. I'll still have corporations in Canada and the United States, and those I'll have to file. I'll probably have a corporation in the Bahamas, and it'll probably own the IP, and we'll have to invoice stuff back to the Bahamas for tax sheltering. Pixie Green says, are all these Chinese drywall houses or whatever? I saw a video, quite negative review. I don't know what Chinese drywall is. I've never heard of that. I don't know if all drywall is made in China, but typically what you would do is, so you have a couple options when you're refinishing or building a house. One of the most future-proof things you could do, if I bought a hurricane house, the house had been trashed by a hurricane. There's a lot of them right now on the West Coast. There's some, pretty much just the West Coast. There's some near like Daytona, got a little bit hurt by the hurricanes, but it was really bad in the West Coast. And so you have one of those houses and the insurance companies have gone and cut the drywall off the bottom half of the whole house because it got wet. And so it's just to the studs. And the way these houses are built, they're concrete block. That's like their insulation, is the fact that it's like concrete block with air in it. And then they strap it with like 2x2, I think it is. And then they drywall to that. And so there's nothing. It's just like to throw drywall on is super cheap. Like if you buy a house that's a hurricane distressed property, 50 grand, you're refinished the house inside. Because expensive stuff's the electrical, the plumbing, the concrete, like everything's, if it's all tile floor, it's fine. The only thing you're doing is replacing drywall and baseboard, which is super cheap. You probably do that for 10 or 15 grand if you can find a Spanish crew to get in there and do it. The people that like to work, because I find a lot of the white culture doesn't want to work. Anyway, immigrants, look for immigrants. But what was I gonna say? Lost my train of thought. Oh, the Chinese drywall. I don't know if all drywall is made in China, but you can buy concrete board Concrete board's fantastic. It's super durable too. I don't know how it holds up in a hurricane, but I assume better. And then you could put trim down that's made of plastic, called PVC trim. It looks like regular trim, but it's made of plastic, so it doesn't mold or destroy. So you could waterproof your house so that literally water could wash into your house, and it's concrete drywall, concrete board, and plastic flooring or tile flooring, which porcelain is fine, and then plastic trim. Like water could wash in and wash out. It's like, as long as it stays below electrical, you're all good. Even if it does, it trips some breakers, minor, right? Insurance pays out pretty well too, so get a good insurance policy for that. But yeah, I mean, it's minor. In the Central Florida, you wouldn't be affected at all. There's no major damage in Central Florida. You could invest in like Orlando. We have one in Lake City right now that we're trying to deal with a tenant eviction. Not even tenant eviction, like squatting on the property. And that's, I didn't want to get into that on the stream, but the nice thing about Florida is the property rights are strong, and that in general, you can hike up rent as much as you'd like, and the tenant can pay it or they can be evicted, and you win. Whereas like in California, New York, everywhere in Ontario, back in Canada, there's just like, it takes a year of a tenant not paying in Ontario before you even get a trial. So it's just a different world. If you screen well, you won't have issue. If you screen well, and you go through a good screening process, most property managers don't, they don't care. But if you can lean into that process a little bit, you'll be okay. So I would recommend leaning in with your leasing agent and review the file. Like look at the 2 top tenant applications and call the references. If you want to spend 10 minutes now to get on the phone with that prospective tenant, I can tell in 10 minutes if I meet someone over Skype or talk to them on the phone, I can usually tell the kind of person that they are. And my gut check has never failed me. I've never had a tenant be delinquent where I've gut checked them. So anyway, something to think about. Let's do some live Q&A here. Hello again from Alberta. What type of paint finish do you use on your walls? So David, it depends. If it's a rough, older property, it's got some dings in the walls, flat. Always a flat finish paint because it hides everything. If you want a washable paint that's durable, I'll go like more of an eggshell finish. Go to your Sherwin-Williams. I have an account there and they're great. They deliver the paint to site for free. They give me great contractor pricing. I don't want to plug them, but like I set up an account down here in the US. They were fantastic. They tinted a bucket. Give me a free $400 pail of paint the other day and delivered it to site. They're amazing. Their reps are fantastic. Their pricing is good. As far as like getting primer, I don't buy that from Sherwin-Williams. Go into your Home Depot, your Lowe's, you get a 5-gallon pail of like your Kills primer for $45, $55. And that'll prime your whole house. Whereas at Sherwin, Dulux, Benjamin, more expensive. So go to Home Depot, go to Lowe's, you're gonna buy your primer, do your paint. If it's a rental, and it's low grade rental, like a $100,000 property or $150,000 small, 3-bedroom, small 1,000 square foot unit or something, I might just paint it, like I just buy that Kills paint for $55 and spray the whole unit. That's it, and that'd be good to go. She's downstairs, baby. She's downstairs. My daughter just walked in. Are there any deals in London? It seems like Florida, there's deals in London too. Yeah, I'm still closing on stuff in London. At least a deal a quarter falls in my lap. That's a slam dunk. I'm not even trying. Eric says, I believe the US will not suffer as much pain as Canadian real estate since less leverage and HELOC involved. Canada will get hit much harder. We've already been hit pretty hard. 30% drop in general. Yeah, she's downstairs. Go on down. Go on down, baby. Go see mama. Go see mama. She's not in here. No, she's downstairs. Go on. Sorry, guys. Go on. Go see mama. Go see her. No? You want to watch me? Okay. All right, you be quiet then. You be quiet for me. You can watch. Subcontractor, spread. How many different ones are you using? I'm just using subs, yeah. So I'm not using AGC at all. Mike, what's the minimum number for Lux Fire? Again, that number is dependent on what you currently live on, what you currently spend. So in general, I would say that number is 25 times your annual expenses or 300 times your monthly expenses. So if you can live on $2,000 a month, then that's like 24 grand a year. Let's call it 25 grand a year for easy math. 25 times 25 is 525,000. So the minimum I would say to rely on is 525 grand. But if you take 525 grand in this market, you buy real estate, you buy strong cash flowing properties, that could produce you 50 grand a year. And so that's bringing you more than double what you need to live on. So then I would say 500 grand could buy you 40, 50 grand a year in income easily. The way I invest, it can be, I know you're having fun rolling that chair. Sorry about the squeaking. She's having fun here with this. Where do you find deals? Wholesalers, realtors, specifically realtors, a lot of realtors. They have off-market pocket listings. They only get paid to make a commission. And on the market is risk. Off market, they have a cash buyer. They're all good. Life is, that's what you want to find. And also just private sellers occasionally too. Tax law. I'm not an expert on U.S. tax law, but how long until I have to purchase a new property? I have no idea about Section 121 exclusive. I don't know. I know that anyone can, she's downstairs. Yeah, go downstairs and get mama. Anyone can 1031 exchange. She's with your sisters. Anyone can 1031 exchange, but Canada won't recognize that. So that's a challenge. Where to get high sitting in cash? Any HISAs you can recommend? I don't know anything about the health savings accounts in the US. Again, I'm not an expert in US tax law. They sound similar to some of the programs we have in Canada. And in general, it makes sense to utilize those programs. In general. Aiden says, hey, Mike, planning on getting my first property this year. With everything you say about Florida market, do you think it makes more sense to start my portfolio there or in my own backyard? Again, it depends. For me, I think I just like the fact that the tenant laws are so strong here and that the weather's beautiful year round. It's a natural fit for me. I like the cap rates better here than at home. I have to go to a shit small city in Ontario to have anything close. I still like Canada too. I like to invest in both places. I'm not saying that Canada is horrible. I think Alberta could crater a little bit and go down further, strongly tied to commodity and oil pricing. So that's a risk factor for that place. But Alberta is the only place that has strong landlord-tenant board, landlord-friendly laws that are not strongly in favor of the tenant the way they are in BC or Ontario. So Airbnb is still safe, I think, in Ontario, in places where you can still do it. There's risk because, again, most cities are banning it. So there's risk in operating it in a gray or quasi-gray area. So it's part of it. But Mason says 4.5% per year. I don't know what that is related to, but maybe rates. Mike says, what research have you done for the states that are very susceptible to climate change? Arizona is related to drought. Drought is meh. Florida hurricane, will insurance cover everything? Yes, for the most part, a good insurance policy will cover everything, so you'd be fine. But honestly, the insurance companies, I'd rather just self-insure, to be honest with you. Put a little bit aside every month. If you're gonna pay $400 a month for insurance, put $400 aside in an account. A major hurricane, I've had properties go through hurricanes now, and I can tell you that by and large, the majority of properties going through a hurricane are largely unaffected. Once in a while, you'll have a freak, accident. But even then, like if I had to rip all the drywall off, it's still 10, 20 grand to redo the drywall in the lower half of the house that gets affected. It's not a huge, it doesn't destroy everything. The chance of your roof getting ripped off, that's rare, very rare, but it could happen. And again, having a good insurance policy for those, one-off situations with a high deductible, I would have that. I think it's a good idea. But I'm largely not worried about it. I think that it's part of the game. In Arizona, drought again is not something that worries me. Like your heating bills would be higher, I guess. Your cooling bills, would be higher. Your HVAC bills would be higher because you're going through really hot periods. I think they'll continue to supply water to major cities. It'll be a non-issue. Drought will not really affect. I don't see it being an issue. In Florida though, there's a lot of stucco framed houses and stuff and timber framed houses. I much prefer concrete block. So you've got to buy concrete block if it's me. And solid stuff. I like newer built stuff because the codes are stronger. They're better. They have hurricane clips on the roof. So the houses you see that get destroyed are often not built well or are older. The newer stuff, built right, under current codes, you'd be just fine. If you're gonna put a metal roof on, put the ones with the screws that are exposed so your roof doesn't get ripped off, the plywood. I like shingle better because shingle's the easiest to fix. Some shingles get ripped off in a hurricane, no big deal. A grand or two, you fix that. Like it's minor, right? That's like if a hurricane actually directly comes into your house, right? For the most part, I'm also trying to buy properties where I see the grading is good. Like the house we're in right now is like 8 feet from the street. And so water have to really come up before, and we're not even close to the ocean. Like we're not affected. We got to drive for a while. So again, buying in Central Florida, unaffected. There's a reason they built Disney in Orlando, I guess South Orlando in the Kissimmee area. But because in Central Florida, by the time the hurricane's gotten to the center, you're fine. There's rarely any major hurricane damage. So there's lots of places you can buy in Florida that are not an issue with that sort of thing. Next question, I gotta go faster here. If you're gonna have a big gain, you have a risky option bet. I want to make it that year, either win big on option or eliminate your tax bill. Mason, I'm lost on that one, but you're talking about gambling, not a good prudent investment strategy. If you're gonna gamble, do it with calls, so your downside risk is limited to the cost of the call. Put $1,000 into buying calls, and like if that stock rips, you can make 10x. But if it goes to zero, your max loss is the money you put in, right? So with options contracts, you can control a lot of shares for a little bit of money. $1,000 can control a lot of share contracts through option contracts. So, yeah. Hey, no problem. Happy to help. Rocky says thanks for the advice. Appreciate it. No problem. Happy to help. Should you set up a corp in the States? It depends on your personal situation. You could operate using a Canadian corp in the US too. Yes. As I get bigger, I need to set up a proper structure, and it's on my to-do list for this winter while I'm here. In Ontario, noticing in his area, resurgence in activity, lots of sales last 2 weeks. Yeah, I'm noticing the same thing actually. I'm looking at data, we're seeing a little uptick, and that's natural. People have been holding off and waiting. And so we should, markets don't just do this. Typically markets do this, right? There's like a seesaw action. And so we should see some up action. Do I think we're gonna get a big rip up in real estate in the next 12 months? No, I don't. I honestly don't. We could get a small blip, but I see it being more flat, or climbing slowly. We could have more downside action too. Again, none of us know for sure. That's why when we buy our assets, we try to buy them with discounts baked in. Hard to do that with stocks unless you're using options. You can use option contracts to delay the time, use time value of money to buy your shares that you want at a discount. You can do that with any company. So that's why I love options trading still. If you're gonna stock trade, use options. Understand it first before you get into something you don't understand. Don't do that. Make sure you understand it. SS says, bad credit, 300K equity with mortgage renewal coming up, worried about my renewal options. What do I do? Well, your bank is going to send you renewal options automatically. You don't even have to qualify. Even if you have no credit, no income, like CIBC, BMO, TD, they'll send you out a renewal option with a rate. You can even negotiate that rate without having to re-qualify at all. So pro tips, your renewal comes automatically. That's why you load up on mortgages, quit your job, it doesn't matter because they don't qualify you anymore on the refis, unless you're changing the structure of the term. But if you're on a 30-year, 25-year amortization schedule and you're on 5-year fixed term, your 5-year fixed term is coming up, they'll send you another fixed term and you can negotiate your rate, and there's no legal paperwork involved at all. They just change the rate on you. So it's super, super easy, and you can negotiate with the bank without having to requalify. So that's the beautiful thing about real estate, is that they almost never call it. They don't want you to pay the mortgage back. They want to leave the mortgage placed. They're incentivized to do so. They send you easy renewal terms. Some banks maybe don't, but every bank that I dealt with in Canada offers renewals, no qualifying. So, oh, by the way, pro tip, I just thought of it, assumable mortgages in the US right now, huge. I was looking at deals where there's a assumable 3% mortgage with a 30-year fixed term. All I have to do is get qualified with them, and I can assume the mortgage when I buy the property. Find properties where people are underwater right now, and for whatever reason, they can't afford their 3% mortgage. Makes no sense, but people get into weird situations. They get divorces, the 4Ds, right? Death, divorce, taxes. I forget the 4Ds. I can't even recite them right now, but whatever. Basically, different situations that come up in your life. There's actually like 8 Ds, but look for those distressed situations. All realtors come up with off-market deals, so call every realtor and talk to all of them and be very specific about what you're looking for, and they'll think of you. And then follow up, follow up, follow up. If your follow-up game is good, you'll win. That's it. And be a strong cash buyer. That's what they want to hear. Easy for them. Whatever's easiest. If you're a strong cash buyer who go in there, even if you aren't a cash buyer, say that you are. Get into their top of their head. Varun says, hi Mike, do you consider break-even values when evaluating to sell or hold a rental after an expensive renovation? 160K spent on a duplex, 4 to 8 year break-even, zero profit if I sell now. So again, it's shitty right now too, because if you hold right now, you're in a situation where you said you're not cash flow positive. Let me just read that comment again. Expensive renovation, blah, 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 depending on SCR. So if you can't sell right now, that sucks because you overspent on renovations. So you didn't, the real challenge is you didn't buy smart enough, low enough. If you're cash flow positive, keep it. If you're not cash flow positive, can you refinance it and pull some money out? So then you have some cash on the sidelines, keep whatever left is trapped and then sell at a good time. Although we might get a rush this spring. We're seeing a little uptick right now in some areas, a little bit in Ontario. So see, for me, it's tough because I can go find another deal that's better. And so it's hard for me to want to hold an asset that isn't great. Or I guess that at current market pricing is, how do I put this? I can always sell the asset and buy something better after renovations, the cash flow is better. And so I keep wanting to chase the next thing. The tax complications are, obviously when you sell, you pay tax. So that might be a situation where if you've already refinanced your capital out, it might be better just to hold the property and wait for a better time to sell, especially if you're cash flow positive. Oh, you said cash flow positive. Perfect. Pull the money out and stay cash flow positive. I would just hold through these times. We've already seen a pretty big pullback. It might go a little bit further, but I don't think Ontario is going that much further down. I think it would more likely will be flat. Would I consider working on a first deal in Florida in exchange for a very large portion of equity, prepared to do all the active work and hustle? Honestly, I no. I prefer to work with people who are going to do, like I want someone who's got enough capital that we can buy in cash, put a mortgage on after, and continue to cycle that capital. And they work just with me exclusive. We continue to roll that capital into lots and lots of deals. It's just not worth it for me to do one small project. And the amount of babysitting I would have to do to teach someone who it doesn't know how to do it, who hasn't done a lot of deals, it's just not worth my time. I'd rather just hire someone who's a pro and then partner and use my team to come in and do it. So unfortunately, that's not something I'm interested in. But I am open to partnerships. Like I do partner with people here, and I partner with people at home too occasionally, and it has to be a good fit, but it's usually someone who's got lots of capital, who wants to bring the money piece. Because I love to hunt. I know the deal piece. And the construction stuff, again, I've got that on lockdown. I do need to hire someone for that role to continue to grow and scale, but mostly what I'm looking for is money partners and people who can help me scale the financing side of things. So if that's you, reach out, let's chat. If you know people who have money, if you have money, put deals together, that's mostly what I'm looking for, but it has to be a good fit too. I'm very picky with who I want to work with, and I don't want a lot of partners. I've had a lot of partners, I don't want that. I want a few select people that I work with. Someone says, I own a property in the US. Do you know any lender that will provide HELOC to Canadian? I don't have a HELOC, but like mortgages, yeah. Bank of Montreal, well, there's lots of lenders in the US who will lend to Canadians. But the big 5 Canadian banks that also have branches in the US who do US lending, especially for a vacation, if you call it a vacation rental, are Bank of Montreal, is BMO Harris, TD, and RBC are the 3 that I know that definitely 100% in the US. Why is a cash buyer easier? Well, because you could put an offer in and close quickly, and a cash buyer goes in firm, whereas someone with a due diligence period is going in there doing a home inspection, they're doing a financing contingency, and they have 7 days of financing, and they waste the seller's time, they waste the realtor's time. No one wants a time waster, and most deals right now are falling apart. And so they want, if they're going to sell it off market and go through, like take that deal off market, potentially sell it for less, get less commission for themselves potentially, they'd only do it if it's going to be easy. So you have to make the transaction super easy for them. And if you do that, you'll get a discount. If you make it hard for them, you're not gonna get a discount. So make it easy. Yeah, that's through all the questions. Sweet, it's been an hour. Thank you everyone for watching. I gotta go down and put my kids to bed. Thank you so much everyone for having come in. Oh, there's another question. I'll answer this one really quick. Separate note, have you explored commercial investments, retail plazas, large multifamily, more reliable tenants, more manageable systems? The challenge with commercial, I think, is that cap rates have been beaten to the point where they're so low that the rate isn't great. So you're not getting a great return on your investment. The other challenge, or I guess pro of commercial real estate, is that if you find good anchor tenants, you're good at finding commercial tenants, and you can bring in a quality commercial tenant, you can increase the value of commercial real estate really quick. But it's also hard to find good commercial anchor tenants. And the vacancy rate in commercial right now is very high. Some people go a year waiting for an anchor commercial tenant. So run your property vacant. It's difficult. So it's a lot harder, especially with businesses going online. There's less people needing retail space. There's a lot of available space. I think we'll see commercial stuff convert into residential. More and more of that. Warehouses turn residential, et cetera, so forth. Because there's just less need for that. So I think it's a shrinking market where margins are low. It's really hard to find a tenant. I can post a house for rent and I can have 50 applications in a month. And I'm comfortable that there's a lot of people and that segment is growing. There's not enough housing to handle the people moving into Ontario, moving into, Canada's taking 500,000 people a year. Where do you put them all? We're not building enough. So I like that segment better because it's so easy to find a tenant. To find your customer in real estate is either your end buyer or your tenant, right? And so with real estate, the great thing is it's so easy when there's a demand. People are begging for housing that your product, if you make a nice product, it sells itself. That's what I love about real estate is your unit sells itself. You don't need a lot of sales skills. And so that's what I like about it. But yeah, commercial, a lot harder. You gotta be a really good sales guy. You gotta have good connections, deep networks. If you have that and you have that network and you can find the commercial tenants, you can buy a building that's half vacant commercial, place great anchor tenants that draw in better commercial tenants, and then sell that property for double and make a great profit. So commercial real estate is a good business to be in. It's not one that I have experience in. I've dabbled a little bit with some mixed use stuff, but I've not bought anything strictly commercial. Yeah, no. The development we did is technically commercial. The 4-lot development. Anyway, I haven't really dabbled in commercial. I don't like commercial for that reason. I might change my tune in the future, but for right now, it's not something I'm focusing on. So thank you everyone for watching tonight. It's been a long stream. We're late. We're well into the 8 o'clock, way past 8 o'clock now. I think we're 10 minutes past 8 or something. But anyway, spend less, earn more, maximize returns. Those are the 3 levers in your control. That's how you build a quality net worth. That's how you build early retirement for yourself. That's how you live the dream life. Thank you everyone for watching. We'll see you next week. If you're watching the replay, come say hi on Instagram at Mike Rosehart. Come say hi on Facebook. Look for the blue check mark on Facebook. I'm verified on Facebook. You'll be able to find me there. And yeah, look forward to connecting with everyone. See you next week.